The reverse crash is coming for Tesla stock. This is something Wall Street can't even grasp at this moment in time. And this could actually start here in this next upcoming trading week. This is vital information you do not want to miss as a Tesla stock investor. There is also one big risk, and really one big risk only, to this thesis, and we will cover that here in this video as well. On top of that, we will go over any and all earnings that will be reported this week, because earnings season is coming up and that will be important. Also, any and all economic data that we will be seeing this week. We will also share with you some interesting statistics about how our markets might perform in the upcoming year. And if that was not enough to cover in one video, we will also go over whether or not the broader markets will continue higher in 2024 or see a bit of a reset. As you know, stocks don't typically go up in straight lines, and that's pretty much what has happened as of lately. So we have a jam-packed video for all Tesla stock investors. I promise you do not want to miss this one. Consider sharing this with a buddy, a friend, a pal. We're going over probably some of the most important information that could help make you money heading into 2024. So, with that being said, let's get started. Let's first start with the thesis of the reverse crash for Tesla stock. The thesis itself is actually pretty simple. Tesla is going to beat the estimates in 2024. Tesla is likely to raise prices and margins will improve. As rates come down, there will likely be this relationship. As rates come down, let's say 50 basis points, Tesla can raise prices, let's say a couple $1,000s every time. Although it's probably not going to be step by step what happens, you're likely to see some prices going higher for Tesla models in 2024. This is going to lead to better margins for Tesla and Tesla beating the EPS estimates, which sit right under $4 per share currently. Specifically, forward 12-month EPS estimates are at $3.97 per share. As per my estimates, Tesla could come in at about $5 of EPS for 2024. That would be $1.25 on average every quarter for Tesla EPS. That seems reasonable to me, maybe a little too low if Tesla actually does start to raise prices. So that's part of the reverse crash thesis, the fact that analysts are going to be wrong. Average investors likely to be wrong as well. I think Tesla is going to outperform expectations is really the bottom line. But take a look at this as well. Analyst consensus for Tesla. 6 analysts have sell ratings, 15 analysts have buy ratings, and 21 analysts have hold ratings. Compare this to some of the top stocks with the highest buy ratings. Amazon at 68, Facebook at 66, Microsoft at 60, Nvidia at 59, Google at 56, even Uber trading at all-time highs. Most of these stocks are at all-time highs, by the way, has 50 buy ratings. Tesla only has 15. Tesla has less than half the buy ratings of McDonald's. So in simple terms, what does that mean? Well, in 2024, you're likely to see a lot of these 21 hold ratings turn into more buy ratings as Tesla does start to beat the numbers. 2 big catalysts coming on the near-term horizon that we know about that will start this process. One is the delivery numbers for Q4, which will be coming out Tuesday at 9 o'clock in the morning, the first trading day of 2024. My estimate, 510,000 deliveries, but anything over 500,000 deliveries is really going to put some pressure on some of these hold ratings and some of these price targets, in which the average price target on Tesla stock is $236 per share, about 5% lower than where Tesla stock is currently at. If Tesla beats the estimates and Tesla stock rallies between 7 and 10%, as I think is possible if we exceed 500,000 for Q4 deliveries, well, yeah, that's going to put a lot of pressure on some of these firms to raise their price targets. See this guy right here? His name is Craig Irwin with Roth Capital. He's been a bear on Tesla for a long time. He has an $85 price target for Tesla stock, and he thinks 2024 is going to be a tough year. But he also said 3 days ago that he has been waiting on an Indian factory to produce a lower priced Tesla model, and that when that happens, well, essentially, they might have to raise their price target. Even some of your bears will have to acknowledge, well, the sun is rising, the music is playing, Tesla stock is going places, especially with a vehicle that will address the masses. I mean, what I'm about to say next is pretty simple, pretty straightforward. What causes a stock to go higher? It is forward earnings estimates going higher. It is analysts raising price targets. Those are the two most impactful things to send a stock higher. And those are the exact two things I expect will start to happen in the beginning of 2024. Actually, when Tesla beats Q4 delivery targets. So that is what gives you the reverse Tesla crash in 2024, meaning Tesla stock, instead of crashing, is going to rally higher. Now, there is one thing that you need to know if that made sense to you. If you can understand how estimates are going to go higher, margins are going to go higher, EPS is going to beat the estimates, and there's many catalysts we know of 2024, $25,000 vehicle, FSD entering China, all of these other catalysts. There's one potential risk that could derail all of this. That is the potential for a recession. Now, I have a belief that a lot of you guys will not share, and that makes me a little bit more confident in this call, because usually what consensus is not correct. I actually think we've been in a recession for the past 2 years. I think we've been in a rolling recession where we just really haven't had that catalyst to push us into a real technical recession. Besides the first 2 quarters of 2022, you were technically negative for GDP during those times. So the government might not say it's a recession, but you were technically in a recession, okay? Think about it like this. Since the year 2000, we've seen 3 recessions. The dot-com bubble. What caused that? Well, average households invested in stocks that went bankrupt. People lost a lot of money during that time. 95+% of those companies no longer exist today. That's a clear catalyst for a broader economic recession. '08, well, yeah, there was some weakness out there, but what really happened is the banks, all of them failed. Almost all of them failed because they were issuing bad loans, bad mortgages. That's no longer the case today. That was a major catalyst. And then you can say the Rona, well, that was not really a recession. That was kind of just numbers getting played around, the economy shutting down temporarily when the government was kind of, giving money away. Okay, I don't really consider that a recession, but you get the main theme here. There's usually a central catalyst that causes a recession. If we do not get a central catalyst that causes a larger recession, that's not going to be, things in China. Okay, that's not going to cause a recession here. You need a catalyst here that is going to cause a recession. In my opinion, you may actually see the economy accelerate in 2024. After all, that's what the data shows. For Q3, we had 5.2% GDP. This quarter, for Q4, the Atlanta Fed GDP Now tracker is estimating 2.3% GDP. It's hard to come to any other conclusion than the economy is probably accelerating here. Now, why could the economy be accelerating? Maybe it's the fact that real wages just went positive for the first time in 18 months. Now, for the first time in 18 months, the consumer can start to potentially get ahead at least a little bit. People have jobs. So mix those two things together and, well, that looks pretty good. What about debt servicing cost as a percentage of total income? Here is that chart. Household debt service payments as a percent of disposable personal income. You're nowhere close to all-time highs. Back in 2007, you were at 13.28%. I mean, today, you're at 9.7%. You were lower during the Rona, right? At 8.3%, but the historical average is like 12%, almost 12% for a debt service payment of disposable income. You're not even close to seeing a problem here. You were higher I mean, pre-pandemic? Or what about the fact that you're actually starting to experience some deflation? If you shopped for, let's say, Christmas, lots of products were way cheaper than they were before, especially kids' toys. I have 2 kids, and shopping for kids, a lot cheaper than it was last year. But that's not even the best part. Gasoline, which is a cost, a tax, if you will, we all face, has dropped, I live in Michigan, from $5 to $2.60. Everyone in the state of Michigan is benefiting from that. Everyone in the United States is benefiting from that. I've done these calculations and I've shared them here on the channel. Anywhere from $300 to $600 billion is being saved just on the drop of gas payments on the average mileage people drive, 12,000 miles a year, and equate that out to average miles per gallon of about 22 miles. Long story short, the consumer is saving potentially $500 billion a year in 2024 just based on the price of gas. So there's a lot of reasons why the economy may actually accelerate in 2024. But again, if there is a central catalyst that causes a recession, well, Tesla stock's not going to see a reverse crash. It's going to see an actual crash. But again, right now, I find no credible evidence to suggest that's going to happen. And trust me, I get it. I'm not oblivious to the fact the yield curve is inverted. I know someone's going to comment down below and say, every time the yield curve has been inverted, we've seen a recession. Why does the yield curve get inverted? Let's just think about this for a moment, right? 10-year treasuries, well, they tend to be, pretty low. People tend to expect rates to stay on the lower side. When inflation happens, in the near term, the Fed has to raise rates. Well, the 2-year treasury, or if you're looking at the 3-month treasury, same thing. The 2 to 3-month treasuries, they follow basically lockstep with what the Fed does. So if the Fed has to raise rates aggressively, then you're going to eclipse the 10-year yield. That's where you get an inverted yield curve. But that's only a reflection of Fed policy. That's not a reflection of the economy. Just normally, when the Fed raises rates that aggressively, something breaks. Well, you can make an argument back in March and April, the banking system broke. Yeah, because banks didn't hedge for risk of higher rates. Well, the Fed bailed them out, so that's not a problem anymore. So really, the yield curve being inverted is only a reflection of Fed policy. It's not a reflection of the economy itself. But again, normally when the Fed raises rates this quickly and you go inverted for this long, something tends to break. But it doesn't always have to break. In my personal opinion, this reverse crash for Tesla stock may actually accelerate quickly. Tom Lee with Fundstrat, this guy right here, the only guy to get the markets correct, or the prediction for 2023 correct, this guy right here. Well, he says small caps could rally 50% over the next year. Why? The main thesis is low valuations, almost record low valuations for small cap stocks, at least what we've seen in recent history. Liquidity coming back into our markets and the economy avoiding a recession. These are also names that are interest rate sensitive. Those same arguments, well, apply directly to Tesla. But again, Tesla has higher quality than small and mid-cap stocks, higher interest rate sensitivity. Tesla's also been starved of liquidity from hedge funds and institutions. They've been under-allocated to Tesla. Tesla just has a large retail base. If Tesla did not have a large retail base, the stock would likely still be in the sub 200s. You'd still be probably in the low 100s right now. But I will make the point, Tesla is higher quality. It's investment grade. So basically any fund anywhere can buy Tesla if they wanted to. Not all funds can buy small and mid-cap stocks. Now, there will be this catch-up effect where the markets kind of catch up to where valuations are for, let's say, Magnificent 7 stocks, which are egregiously overvalued in my personal opinion, especially ones like Apple or Microsoft. The average hedge fund manager has underperformed the S&P 500 for the last 2 years. You can't do that again in 2024. So your option here is to underperform in Magnificent Seven, big tech names, or to go a little more on the risky side, invest in Tesla and small and mid-cap stocks. So Tesla should see a lot of inflows, likely starting in 2024, pretty soon. Again, especially if Q4 deliveries come in better than expected. This could start a wave of capital heading into Tesla stock. That's why my base case is for Tesla to end the year of 2024 around $450 per share. I think Tesla could hit as high as $600 per share if we get the $25,000 vehicle being announced, if things go better than I even expect, if EPS comes in at, let's say, $5 per share, $5.50 per share, if Tesla's multiple can expand to 100 instead of the 70s, well, there you have it. 100 times multiple, let's say $5.50 of EPS, you're at $550 for Tesla's stock price. And let's also say we avoid a recession. It's as simple as that. That's what gets you to $500 or $600 per share. But I think I'm being a little bit more on the conservative side. Actually, believe that or not, saying Tesla stock likely hits the $450 range. In the near term, coming on Tuesday, you could see a 7 to 10% rally in Tesla stock, in my personal opinion. If that sends us into the high 260s, 270s to start 2024, if you break this longer term downtrending line of resistance, which is about 260, oh my gosh, you could be in for an aggressive rally over the next 3 months. So mark my words now. I think Tesla stock likely rallies about 82%. That would put Tesla stock at $450 per share. On the higher end, I think Tesla stock could rally to about $550 per share. That would be a similar gain of about 123% from here as we've seen in 2023. So it's really not that egregious to think Tesla stock could hit $400, $500, even potentially $600 per share. That would be 140% gain from here. All you need, again, is to avoid a recession, beat the estimates, and multiple expansion. That's it. And you could be $600 per share by the end of 2024. But again, if you guys have a bear thesis on Tesla that I am ignoring, let me know down below in the comment section. I think interest rates falling is going to spur the consumer. I mean, how could it not? There's a lot of people that bought cars in 2020 and prior that are likely looking for an upgrade at this point, but probably cannot afford it because of where interest rates are now at. I mean, my mom's one included. Like, personally, people I know want to upgrade their vehicles, but it's just so much more expensive today for the same vehicle that they can't stomach that. But again, the number one risk to Tesla stock in 2024 is some unforeseen event, catalyst, that causes a recession. If that happens, forget this video was ever posted or you ever heard this or heard this information, because Tesla stock will not do well in 2024. I don't really think Tesla stock will fall that much, at least by the end of 2024. I think you'd probably still be in the, mid to low 200s if a recession does happen. Remember, the average Tesla buyer anyways is not average America. It's a little bit on the higher income bracket earners. So a shallow recession should not, in theory, affect Tesla as much as it might another car company. But again, that's only just in theory. Now, if we look at the economic calendar, you guys can use this free tool. It's tradingeconomics.com/calendar. I want to go over this here in this video. We'll talk about it more in depth coming tomorrow as well. But considering we're going to get delivery numbers for Tesla on January 2nd, Tuesday, the first trading day at 9 o'clock in the morning, Eastern Standard Time, well, this data could have a big impact on Tesla stock as well. Considering I think the stock's going to move higher, any good or bad data could obviously move things for Tesla. Now, Tuesday, there's not going to be much. Some bond auctions, nothing too crazy at all. On Wednesday, ISM manufacturing PMI and JOLTS job openings will come out. JOLTS job openings will be a major catalyst. You will also get the FOMC minutes that come out 2 p.m. on Wednesday. On Thursday, You're not going to have too much. The ADP employment change, that could be a big one. That is the best glimpse into what Friday's non-farm payroll report could look like. So on Friday, we're going to get the non-farm payrolls, which again, we're going to have a pretty good insight from that, from the ADP employment change. ISM services PMI, factory orders, and a bunch of secondary data that comes with ISM services prices, ISM new orders, ISM services employment, business activity, so on and so forth. So contrary to last week where we didn't have really any big economic data, this upcoming week, well, we will have some big data reports. Here in the week ahead, as far as earnings, we really don't have much. You have Walgreens that reports Thursday pre-market, couple other different names, including Conagra Brands. Thursday after hours, nothing notable. Friday pre-market, Constellation Brands. But none of these earnings are really going to be impactful for our markets. We will start to get some banks that report earnings coming the following week, and then really the third week of January is going to kick off earnings season for the most part. And don't be surprised, at least in the near term, with a pretty straight up kind of parabolic move we've seen in the S&P and the NASDAQ, that the S&P and the NASDAQ actually fall from here. That's what I'm expecting. Now, in my opinion, they could fall probably about 2-3% pretty reasonably, maybe 3 or 4%. That would put you back to your July highs on the SPY. But I don't think it's going to be equal. I think a lot of money is likely to flow out of Magnificent Seven names that really don't stand to benefit from the Fed lowering rates in 2024 and make its way, that capital at least, into interest rate sensitive names, into names that have lagged the markets over the past 2 years. So in theory, you could see the S&P, the NASDAQ fall on an index level. You could see IWM or the Russell 2000, small mid-cap stocks, interest rate sensitive names, actually do well. Because, I mean, Magnificent Seven is almost 40% of the S&P. It's like almost 45% of the triple Qs. So yeah, those names doing poorly, seeing outflows, will bring down the broader indexes. But I don't think it's going to be something where everything falls. So let me know what you think about all of this information down below in the comment section. What do you think the gain's going to look like for Tesla stock in the year ahead? Hit the like button as well as subscribe to the channel. Consider sharing this video with a buddy, a friend, a pal, someone you know that needs to hear this information. If you guys also want to come trade with us throughout 2024, check out the link down below in the description of this video. You guys have a great rest of your day, and I will see you in the next one.